Stock trading is the buying and selling of shares in publicly listed companies with the goal of generating profit. It spans multiple concepts: how markets work, strategies, risk, tools, psychology, and regulation. Here's a comprehensive but readable overview. Nuster 1. What a stock actually is. A stock represents partial ownership in a company. If you buy shares of a company like Apple Inc., you own a small fraction of that business. Your return can come from price appreciation, selling for more than you paid, dividends, cash payments distributed to shareholders. Stocks trade on exchanges such as the New York Stock Exchange and NASDAQ. Number 2. Types of market participants. Investors, long-term holders focused on fundamentals. Traders, shorter term, focused on price movement. Institutional investors, hedge funds, pension funds, banks. Retail traders, individuals trading their own money. Institutional activity often moves markets due to scale. The main trading styles differ primarily by how long trades are held, how decisions are made, and how much time you need to commit. Each style also carries different risk levels and skill requirements. Scalping is the shortest term style. A scalper may hold a trade for seconds to a few minutes, sometimes making dozens or even hundreds of trades per day. The goal is to capture very small price movements repeatedly. Scalpers usually focus on highly liquid stocks, often large-cap names like Apple Inc. or Tesla Inc., because tight spreads and high volume are essential. They rely heavily on level 2 order flow, time and sales data, and very short time frames such as 1 minute or tick charts. The advantage is limited exposure to overnight risk. The downside is that transaction costs, mental fatigue, and execution speed become critical. Scalping generally requires fast internet, a responsive brokerage platform, and strict discipline. Day trading involves opening and closing all positions within the same trading day. Unlike scalping, trades may last from a few minutes to several hours. Day traders often look for intraday patterns like breakouts, pullbacks, and momentum moves. They may trade around news releases, earnings announcements, or economic data. The benefit is avoiding overnight market risk. However, it demands constant attention during market hours and strong risk management. In the United States, frequent day traders also encounter the pattern day trader rule enforced by the Financial Industry Regulatory Authority, which generally requires maintaining at least $25,000 in equity for margin accounts that execute frequent day trades. Swing trading sits between day trading and longer-term investing. Trades are typically held for several days to a few weeks. Swing traders attempt to capture portions of larger moves rather than tiny intraday fluctuations. They often use daily charts and indicators such as moving averages, trend lines, and momentum oscillators. Because positions are held overnight, swing traders face gap risk, where prices jump up or down outside trading hours. However, this style is less time-intensive and allows traders to analyze markets outside of working hours. Swing trading is popular among people who cannot watch charts all day but still want active involvement. Position trading extends the holding period to weeks or months. Position traders focus more on overall trends and macroeconomic conditions. They may analyze interest rates, sector rotation, or earnings growth. Technical analysis is still used, but decisions rely more heavily on broader trends and fundamental factors. For example, a position trader might buy stocks in a sector showing sustained growth and hold through minor pullbacks. This style reduces trading frequency and transaction costs, but requires patience and tolerance for short-term fluctuations. Long-term investing is the least active approach. Investors buy stocks intending to hold them for years. The focus shifts almost entirely to company fundamentals, growth potential, and long-term economic trends. Investors may track broad market indexes such as the S&P 500 or invest in diversified funds. This approach benefits from compounding and typically involves lower stress and fewer decisions. However, it requires patience and acceptance of market cycles, including bear markets. The styles differ in time commitment, difficulty, and risk. Scalping and day trading demand the most screen time and fastest decision-making. Swing trading requires moderate involvement. Position trading and long-term investing require less frequent monitoring, but more tolerance for market swings. Many traders eventually combine styles, for example, long-term investing for core holdings, while swing trading smaller allocations. A simplified comparison helps clarify. Scalping. Seconds to minutes, highest activity, smallest targets, very technical. Day trading, minutes to hours, high activity, intraday patterns. Swing trading, days to weeks, moderate activity, trend-based. Position trading, weeks to months, lower activity, macro trends. Long-term investing, years, lowest activity, fundamentals, and compounding. Choosing a style usually depends on available time, risk tolerance, and personality. Someone with a full-time job often gravitates towards swing or position trading, while those who prefer rapid decision-making may be drawn to day trading or scalping. Now 4. How prices move. Stock prices change due to supply and demand, earnings reports, economic data, interest rates, news and sentiment, market liquidity. For example, higher interest rates often pressure growth stocks because future earnings are discounted more heavily. Stock prices move because buyers and sellers continuously compete. Every trade happens when someone is willing to buy at a certain price and someone else is willing to sell. The factors you mentioned mainly influence that balance. Supply and demand is the core mechanism. If more traders want to buy than sell, price rises because buyers must offer higher prices to get filled. If more want to sell, price falls. This imbalance often appears when large institutions place big orders. For example, if a fund decides to accumulate shares of Nvidia Corporation, they cannot buy everything at once without pushing price up. Instead, they buy gradually, creating sustained upward pressure. Conversely, when institutions distribute shares, supply overwhelms demand and price trends downward. Order books show this in real time. Stacked buy orders create support, stacked sell orders create resistance. Volume is important here. Strong moves usually occur when high volume confirms that many participants agree on direction. Earnings reports are one of the most powerful catalysts. Public companies report quarterly financial results that include revenue, profit, and guidance. The key is not just whether results are good, but whether they beat expectations. If analysts expect $2 earnings per share and the company reports $2.50, demand often increases quickly. Guidance matters even more. A company like Amazon.com Inc. could report strong past earnings but fall if future outlook is weak. Prices also move due to positioning. If traders anticipate strong results, the stock may rise before earnings and then fall afterward, even with good numbers. This is sometimes described as buy the rumor, sell the news. Economic data influences the broader market. Reports such as unemployment numbers, inflation data, GDP growth, and consumer spending affect expectations about the economy. For instance, higher than expected inflation may lead traders to believe borrowing costs will rise. That often pressures growth stocks, which rely on future earnings. Data releases from agencies like the U.S. Bureau of Labor Statistics can cause sudden market-wide moves within seconds. Indexes such as the Dow Jones Industrial Average and the Nasdaq Composite often react immediately. Interest rates affect stock valuations. When rates increase, bonds become more attractive relative to stocks, pulling money out of equities. Higher rates also make borrowing more expensive for companies, reducing expansion and profitability. Growth stocks are especially sensitive because their valuations depend heavily on future cash flows. Decisions from the Federal Reserve often trigger large moves. When the Fed signals rate cuts, liquidity increases and stocks frequently rally. When it signals tightening, markets often decline or become volatile. News and sentiment drive short-term price swings. News includes mergers, product launches, lawsuits, leadership changes, geopolitical events, or regulatory decisions. Positive news increases demand quickly, negative news increases supply. Sentiment is more subtle. It reflects collective psychology. If traders feel optimistic, they buy dips aggressively, pushing prices higher. If fear dominates, even small negative news can cause large drops. Social media and retail trading communities can amplify this effect, especially in highly discussed stocks. Market liquidity refers to how easily shares can be bought or sold without significantly affecting price. Highly liquid stocks trade millions of shares daily, allowing large orders to execute smoothly. Less liquid stocks move more dramatically because fewer shares are available at each price level. For example, mega-cap companies such as Microsoft Corporation tend to move more gradually, while small-cap stocks can spike or drop rapidly. Liquidity also varies by time of day. The market open and close usually have the highest liquidity, while midday, tends to be quieter. Low liquidity increases volatility because even moderate orders can push price sharply. These factors often interact. A strong earnings report during a period of low liquidity can produce exaggerated moves. Economic data combined with interest rate expectations can shift sentiment across the entire market. Ultimately, all of them feed back into supply and demand, which directly determines price movement. 5. Fundamental analysis. This approach evaluates a company's financial health, revenue growth, earnings per share, EPS, price to earnings ratio E, debt levels, cash flow, competitive advantage. Fundamental traders ask, is this company worth more than the current price? Fundamental analysis tries to estimate a company's intrinsic value by studying its business, finances, and environment. The idea is to compare that estimated value with the current market price and determine whether the stock is undervalued or overvalued. Investors using this approach typically hold positions longer because fundamental changes take time to affect price. The starting point is understanding the business itself. This includes what the company sells, how it makes money, its competitive advantages, and the industry it operates in. For example, a company like Apple Inc. earns revenue from hardware, services, and ecosystem lock-in. Analysts consider whether that business model is durable. They also examine market share, pricing power, and barriers to entry. Companies with strong brands or high switching costs usually receive higher valuations. Financial statements are central. There are three primary ones: the income statement, balance sheet, and cash flow statement. The income statement shows revenue, expenses, and profit. Investors look for consistent revenue growth and improving margins. A company whose revenue is growing 20% annually is typically valued differently from one growing at 3%. Profitability matters as well. High gross margins indicate pricing power, while improving operating margins suggest efficiency. The balance sheet shows assets, liabilities, and shareholder equity. This helps evaluate financial stability. A company with high debt may struggle if interest rates rise. Analysts often compare total debt to equity or earnings. Cash reserves also matter. Firms like Microsoft Corporation often hold large cash positions, which provide flexibility for acquisitions, dividends, or weathering downturns. The cash flow statement reveals how much real cash the business generates. This is important because accounting profits can differ from actual cash. Free cash flow, which is operating cash flow minus capital expenditures, is often considered one of the most important metrics. Strong free cash flow means the company can reinvest, pay dividends, or reduce debt. Investors also use financial ratios to compare companies quickly. The price to earnings ratio, PE, compares stock price to earnings. A high PE suggests investors expect strong future growth. The price to sales ratio, PS, is useful for companies not yet profitable. Return on equity, ROE, measures how efficiently a company uses shareholder capital. Debt to equity indicates financial leverage. No single ratio tells the whole story. They must be interpreted together and relative to industry norms. Growth analysis is another component. Investors evaluate whether earnings and revenue are accelerating or slowing. Growth investors often prefer companies expanding rapidly, even if valuations are high. Value investors look for companies trading below their perceived intrinsic value, sometimes due to temporary issues. A classic example of a value-oriented approach was associated with Warren Buffett, who focuses on durable businesses purchased at reasonable prices. Industry and macroeconomic context also matter. A strong company in a declining industry may struggle. For example, demand shifts, regulatory changes, or technological disruption can affect entire sectors. Analysts compare competitors to determine which firm has advantages. This is sometimes called competitive analysis. Factors include cost structure, innovation, brand strength, and distribution networks. Management quality is another qualitative factor. Investors examine leadership track records, capital allocation decisions, and corporate governance. Consistent, disciplined management often leads to better long-term performance. Conference calls and shareholder letters are commonly reviewed to understand strategy and tone. Valuation models attempt to estimate intrinsic value numerically. One common approach is discounted cash flow analysis, which projects future cash flows and discounts them back to present value. Another approach uses comparable company analysis, comparing valuation multiples across similar firms. These models depend heavily on assumptions, so results vary. Dividends are relevant for income-focused investors. Companies that pay consistent dividends may appeal to those seeking regular income. Dividend yield compares annual dividend to stock price, while payout ratio measures how much of earnings are distributed. Sustainable dividends usually come from stable cash-generating businesses. Fundamental analysis is slower than technical trading, but it aims to capture longer-term mispricing. Investors using it often accept short-term volatility as long as the underlying business continues to perform well. 6. Technical analysis. This focuses on price charts and patterns, support and resistance, moving averages, trend lines, volume analysis, indicators, RSI, MACD. Technical traders ask, where is price likely to move next? Technical analysis is the study of past price and volume data to anticipate future market movements. Unlike fundamental analysis, it doesn't focus on a company's intrinsic value. Instead, it assumes all available information is reflected in price. Traders use charts, patterns, and indicators to identify trends, reversals, and potential entry or exit points. Here's a detailed breakdown of the components you mentioned: support and resistance. These are horizontal or angled price levels where buying or selling pressure tends to emerge. Support is a level where demand typically exceeds supply, preventing price from falling further. Resistance is where supply exceeds demand, capping upward movement. For example, if Tesla Inc. stock repeatedly bounces at $700, traders see $700 as support. If it repeatedly fails to surpass $750, that becomes resistance. Breaking through these levels, especially on high volume, often signals strong momentum in the breakout direction. Moving averages. These smooth out price data to highlight trends over time. The two most common types are the simple moving average SMA and exponential moving average EMA. A 50-day SMA, for example, shows the average closing price over the past 50 days. Traders look at crossovers for signals, a shorter-term moving average crossing above a longer-term one, e.g., 50-day crossing 200-day, is bullish, while the opposite is bearish. Moving averages can also act as dynamic support or resistance levels. Trend lines. Trend lines are straight lines connecting two or more significant highs or lows, showing the general direction of price. An upward trend line connects higher lows, indicating a bullish trend, while a downward trend line connects lower highs, indicating a bearish trend. Breaking a trend line often signals a potential reversal or acceleration in the opposite direction. Volume measures the number of shares traded over a period and validates price moves. Rising prices on increasing volume are considered strong and sustainable, while rising prices on low volume may indicate weak momentum. Volume spikes often accompany breakouts, reversals, and major news events. Traders also use indicators like the volume weighted average price, VWAP, to assess average price levels relative to traded volume. Relative Strength Index, RSI. RSI is a momentum oscillator that ranges from 0 to 100, measuring the speed and change of price movements. Traditionally, an RSI above 70 suggests a stock is overbought, possibly due for a pullback, and below 30 indicates oversold conditions. Divergences between RSI and price, e.g., price making new highs while RSI fails to do so, can signal potential trend reversals. Moving Average Convergence Divergence, MACD. MACD is a trend-following momentum indicator showing the relationship between two EMAs, usually the 12-day and 26-day. The MACD line minus the signal line generates buy or sell signals. Positive MACD values suggest bullish momentum. Negative values indicate bearish momentum. Traders also look for MACD crossovers and divergences for early trend reversal clues. Other popular indicators: Bollinger Bands. Bands placed above and below a moving average to measure volatility. Price touching the upper band may indicate overbought conditions, while touching the lower band suggests oversold. Stochastic Oscillator compares a stock's closing price to its price range over a period, highlighting potential overbought or oversold levels. Fibonacci retracements, horizontal lines derived from key Fibonacci ratios, 23.6%, 38.2%, 61.8%, to identify potential support or resistance during price corrections. Average True Range, ATR, measures market volatility. Higher ATR means more price fluctuation. Technical analysis works best in markets with high liquidity and trend consistency. Many traders combine multiple indicators looking for confluence, situations where several signals point in the same direction. However, no single indicator is perfect. False signals and whipsaws are common, so risk management and confirmation with multiple tools are essential. 7. Common order types: market order, buy sell immediately at best price; limit order, buy sell at a specific price; stop loss, automatically sell to limit losses; stop limit combines stop trigger and limit price. Stop loss usage is central to risk management. 8. Risk management, arguably the most important part. Key principles: never risk too much on one trade, often 1-2% rule. Use stop loss orders. Avoid overtrading. Diversify positions. Maintain cash reserves. Even profitable traders lose frequently. Risk control keeps them solvent. Number 9. Key market sectors. Stocks are grouped into sectors: technology, healthcare, financials, energy, consumer discretionary, industrials, utilities. Sector rotation occurs when money flows between these areas depending on economic conditions. Bull versus bear markets. Bull market, prices trending upward, optimism dominates. Bear market, prices trending downward, pessimism dominates. A decline of 20% in major indexes is often used to define a bear market. 11. Tools traders use: brokerage platforms, e.g. Charles Schwab, Fidelity Investments; charting software; screeners for finding stocks; news feeds; economic calendars. 12. Common beginner mistakes: trading without a plan, over-leveraging, using margin, chasing hype, ignoring risk management, emotional decision-making, trading too frequently. NER taxes, U.S. basics. Short-term gains held 1 year, taxes ordinary income; long-term gains, lower tax rates. Wash sale rule prevents claiming losses if you rebuy quickly. Tax impact can significantly affect net returns. Number 14. Popular strategies: momentum trading, value investing, growth investing, dividend investing, breakout trading, mean reversion. Each performs differently depending on market conditions. Number 15. Psychology of trading. Emotions heavily influence outcomes. Fear causes premature selling. Greed causes holding too long. FOMO leads to bad entries. Overconfidence increases risk. Successful traders rely on discipline and rules. Number 16. How beginners typically start. 1. Learn basic concepts. 2. Open brokerage account. 3. Start with paper trading simulation. 4. Use small capital. 5. Track trades in a journal. 6. Gradually refine strategy. 17. Risk versus reward reality. Most new traders lose money initially. Long-term success usually comes from consistency, risk management, patience, experience over time.